So I was cut off. I only have 15 minutes on this free version of my video software that I use. I think I was saying that IMA ethics, you need to read those sections and thoroughly know them. You get one page notes too, right? So be familiar with the kind of data that would interest a manager. Read that part of the chapter. Be familiar with it. Refer to the table in chapter 9 I referred to. For 14, know the costs associated with holding inventory and be able to analyze a question. All right, so there's cost to holding inventory, and that's one of the benefits of just-in-time inventory is that holding cost is no longer involved. And some of y'all may have studied the economic order quantity. Some of this is going to be a review. Some of it will be new, depending on who you are. Relevant range. Love the concept of relevant range. You need to know that for the exam. So like your favorite retail store, right? Just say it's 50,000 square feet. Really busy, shelf. They're always stocking, right? That store is at capacity for 50,000 feet. They add on, let's say they double, it goes to 100,000 square feet. Now they need an extra manager or two. Managers are normally on salary. So now the fixed cost has changed. We had a store of 50,000 square feet. That was the relevant range. Now we've doubled the square feet. Now the relevant range is different. So fixed cost within the relevant range is fixed. Let's say it's $100,000. Sell nothing, fixed cost is $100,000. Sell the max the store could handle effectively, man, the fixed costs are $100,000. Okay, so within the relevant range. And then also, variable cost per unit remains the same. Variable cost per unit, and we all know variable costs because we're paid. Let's say when we were working high school, college jobs, just starting out. Let's say we're making $10 an hour, right? $10 an hour. You work nothing, you get paid $0. You work 1 hour, you get paid $10. You work 40 hours, you get paid $400. So the relevant range is between 0 and the max is 40, right? Because if you go over 40, you're paid time and a half. The relevant range changes. So within that relevant range, the cost per unit of labor is $10 an hour. And then as somebody works more and more at $10 an hour, they get paid more and more and more. Total variable cost increases as volume increases while remaining constant total cost per unit. The exact opposite happens with fixed cost. Fixed cost, let's say, is $100,000 for the entire month. We sell 1,000 units. We can calculate fixed cost per unit. 100,000 a month. We sell 10,000 units in the month. Fixed cost per unit is less. You need to know this for the exam. I have a video that I touched on that. Make sure you understand it, but it's all related to the relevant range. And you guys that are engineers and other related sciences, math, you guys understand the relevant range. It might be called something different, but there has to be parameters, and then within those parameters, we can make assumptions. For us, we make assumptions that fixed cost, dollar amount is constant, variable cost per unit is constant. Okay. Then 17, I just touched on it. Another example where you watch the video that I talked about earlier. Another video. Now you need to know the difference between contribution margin income statement and gross margin. Let me tell you right now, gross margin is GAAP. That's what's reported externally. Contribution margin is internal. And the contribution margin leads us to all sorts of concepts that we talk about in our material for this exam. Cost, volume, profit analysis, or the break-even analysis, or we plug in, instead of 0 for break-even, we throw in target income. This cost, volume, profit analysis lets us also look at operating leverage, the magnitude of operating leverage, break-even, target profit, margin of safety. So it's essential to understand the contribution margin income statement, but keep in mind gross margin is what is used for external reporting or GAAP. Another video, know the value added principle. And while we're at it, let's go ahead and say no upstream and downstream costs. Period costs. I always say in the videos, selling and admin will get you through most of them, but R&D also is a period cost. R&D is also a period cost. Now, the deviation from R&D being a period cost would be if those research and development costs can be used for other products, processes, or services. Then we could capitalize it and we would amortize that differently. But for us in this course, a period cost. Operating leverage again, another video for 26 and 27, break even formula. Now, you guys know by the time you're watching this that sales minus variable cost is contribution margin, right? X is the number of units sold. So subtracting sales minus variable cost, you have contribution margin times X. Fixed costs, obviously, we don't have an X there because it's not based on volume. If you put 0 there, that's break even. You're not going to lose $1. You're not going to make $1. If you put a positive number there, that's targeted income. We have a problem in the videos and homework for that, or connect. Leverage. We've got to understand leverage, so make sure you read that part of the chapter, operating leverage. Another video, table for 32. Video. Need to know the break-even formula. There's homework and videos for that. Table. Another question about the relevant range. If you're going to have me for this, you're going to have questions on relevant range. It's fundamental to making these assumptions that we make with fixed and variable costs. Mixed costs too. Video. Opportunity cost. Let's just use undergrad. Because usually undergrad students aren't working full-time. They don't have a career. MBA students, you got a career. We can use either one. So ask undergraduate students, what are you giving up by going to school? The full-time job should be the answer, right? So while you're in school, you're paying to go to school and you're not earning income. That opportunity of not earning income is a cost that needs to be factored in the cost of education. So you don't make money while you're in 4 years in school. Your friends that just went straight to work after high school, they've made X number of dollars. By the time you get through with your degree, they're ahead, right? So the plan is, and it works, it still works. It's business majors. I'm talking to business majors now. I won't address anything else. So business majors, I don't know anything else, so I can't address it. So business majors will make much, much, much more on average than people that didn't go and pursue a 4-year degree. High school graduates only, okay? It's a fact. Nothing's changed. Is it as good as it was 50, 60 years ago? Probably not as good as it was. There's some truth to that. So if you hear anybody say anything, there's some truth. But every time I study this, it's still the best bargain out there, all right? MBAs even more. What would you guys be doing if you're working full-time and getting your MBA? There's a cost there. Whatever that is, you're giving something up that you could be doing, right? I'm out working now. I have 2 kids in college. My wife has a car. I have a car. I change my own oil. Now, I don't save enough to say that, I could just do some consulting work. I could do consulting work and make more money. Okay, so during that time, there's an opportunity cost. So technically, I'm losing money. I am also going to do both. So I will do both, So I had 2 kids in college. I have to work like crazy. So that's my opportunity cost. No matter what. That is not an expense on the financial statements. That is used for decision making only, and it is not a reportable item on our financial statements. There is no opportunity cost, opportunity expense on our chart of accounts. None. No time, just in time. calculate margin of safety. There's a problem on that. Miscellaneous, hey, I'm covering 50 questions. I can't cover everything. 42, another video on fixed and variable product and period costs. Value adding and non-value adding, again, upstream and downstream, know that. There's a video on calculating cost of goods manufacturer statement. Okay, you got 1-page notes. Another question on fixed, variable, and mixed cost. Be familiar with a breakdown of the contribution margin statement and the gross margin statement. Videos on that, chapter readings, value and non-value adding, again, upstream, downstream. Now, I got 48 is just a statement you get to learn. I shouldn't have done that. That's an accident, but it's already done. I'm not going to change my study guide. Direct costs can be directly and efficiently traced to a cost object or a product. That is the classic definition of direct costs. Sometimes they won't put in the efficiently part, but I think it's still, there's all sorts of direct costs, right? The question is efficiently, and that is a determinant for the individual company, right? So it might not be efficient to do so. I don't think it's efficient to measure the amount of paint per lawnmower. Let's say push lawnmower. That's not a lot of paint. I don't think we could measure it directly. Perfect, could be a direct cost. I don't think it's efficient. I wouldn't. If I was at the plant, I would make that an overhead and indirect material cost. But I guess some places do, some don't. That would be their decision. I never worked in a lawnmower manufacturing facility. Somebody could probably chime in on that maybe works at a small engine company. If you got me, you're going to have to know this. Inventory is an asset. Cost of goods sold is an expense, where we expense that inventory. So first hits the balance sheet, inventory. When it's sold, then it hits the income statement. When you buy a building, it goes on the balance sheet. When we expense it through depreciation a little bit every year, it hits the income statement. Got another question on ethics. All right, so this concludes the video on the study guide. If you have any questions, please let me know.